Welcome back. This is Chart Overload. We are Sollinda Capital Management. I am Ryan Mumy, the CEO, and with me is Justin Greenhill, our chief fellow founder and our chief investment officer. Justin, I just want first things first, clear the air. I am not wearing a Duke hoodie. I get it often being in North Carolina. Oh, you're a Duke fan. I'm not really a basketball fan. This is my alma mater from high school, Defiance High School in Defiance, Ohio. So just setting the air straight. I don't want to lose anyone that might bleed the other blue for Chapel Hill.
Don't follow sports.
Anyways, yeah, it's funny you did the. I appreciate you supporting my son Logan and his wrestling team.
That wasn't a small contribution.
Yeah, it wasn't. It wasn't. It was impressive. But the comment is what you can put a little tag on, like, "Hey, go." Justin put "Go Team Sports." It was, which again,
what I found
perfect.
so funny about that is, like, when they hit you with the email to donate, after you donate, they automatically make it difficult for you to not top it up and donate even more. So if you pick X, you end up adding like 20% to X.
So they hit their target yesterday, and as a result, the head coach, who's 30, 31, who's a successful college wrestler, qualified for the NCAA tournament 3 times, but he's got to wrestle in the U.S. Open now, which is like it's Olympic wrestlers are there, so it's going to be exciting to watch. Anyways, this is Chart Overload, not catch up on Ryan and Justin's what we're giggling at. But through this, we're going to walk through some charts. We're going to talk about what we think's interesting. Maybe mainstream media is not talking about it enough. But let's get started with big picture, right? So this first chart is from the Atlanta Federal Reserve Board. They put out this GDP now, this estimate, and contrary to a lot of the negative narrative that's out there, GDP is looking pretty strong.
Yeah. So what you see in this chart is basically it's kind of rated higher from what was a lower starting point for most of the year. So you can credit that to tariffs being absorbed, or the possibility that they're going to be less impactful. But nonetheless, and this is real-time economic data as well, so it's a forward-looking, and it's pretty robust. And
and it's substantially ahead or above, and it has been, as you mentioned, it's substantially above estimates from the street.
Yeah, and a lot of this is kind of what we've discussed in recent commentary, is the expectation that there's a fiscal impulse coming into the economy into next year, and a pickup in the consumer.
From depressed levels, yeah. Right? Next chart, looking at average hourly earnings and the unemployment rate. Unemployment rate did tick higher in the most recent data that was delayed because of the government shutdown, but also we've seen hourly wages tick a little bit up here recently.
Yeah, and as we've discussed pretty at length at this point, is the unemployment rate is basically picking up from what was an extremely low level post-COVID. So that's something to keep in mind. But nonetheless, a bit of a divergence there.
Yeah, and the Challenger report, this week, which people all of a sudden are paying more attention to because we didn't have government data. But, the layoffs are high since COVID, but to Justin's point, they're off very low levels. Something to continue to monitor. This isn't really a fire everyone, lay off people, but it's also, there's not some robust hiring. So it's, could it be in a Goldilocks neutral position? I don't know. Next chart looks at Bank of America Global Fund Manager Survey, and cash levels are pretty low right now.
Yeah, so oftentimes people look at this and they kind of want to make it an alternative or a contrarian indicator, meaning that when cash levels are high, one should be bullish, and when cash levels are low, it should be the opposite. But as we've been discussing a lot internally and kind of reemphasizing, a lot of these mean reversion or fade indicators work much better after stocks have sold off than they do working to call the top in the stock market. So just because cash levels are low doesn't mean that new money can't be flowing into the market still yet and push stocks ever yet higher. But fund managers as a broad category are all in at this point with the capital they currently have.
Correct. And the counter to this is the next chart, which is U.S. money market fund assets are the highest they've ever been.
Yeah,
which is cash on the sidelines.
Which is cash on the sidelines, right? And not to say that all money market funds are going to be driven into the stock market, but we know from working on the front lines with advisors and end investors, when they do have money in money markets or safe investments and they see the stock market going up, they do tend to, get a little bit more interested in taking more risk with that money. So that's some dry powder.
It doesn't have to be binary, all or nothing, right? It can just be, hey, take some of it, and some of $8 trillion is quite the thrust in equities.
Keyword.
Next chart looks at bankruptcies of what they consider ma and pa, smaller businesses, and those have ticked up this year, just like last year.
So this, we're going to put this in the category of what we call, and obviously we didn't make this up, the K-shaped economy, meaning that, both things can be true simultaneously. You can have some pretty significant weakness in areas of the economy that are not the stock market, such as, small business bankruptcies. And at the same time, you can have a very robust stock market. And that's kind of what we're dealing with at present.
With companies making money, right? Earnings. Not necessarily just multiple expansion. Next chart on the economic data front looks at China's factory activity levels, and these have been depressed, and they still are depressed.
Yeah, so you kind of have to look at this through two different lenses. One, you can look at it from the standpoint of, the consumer outside of the top 10% socioeconomic class in the U.S. has been somewhat depressed as a function of what have been higher interest rates, et cetera. And that obviously means that there's going to be less manufacturing and exports from China. You've got, the trade tariffs and the uncertainty around that as a factor as well. But I think maybe less obvious is you have the fact that there is so much extreme competition for everything as there was in China that's been driving the price of things down. The government there now actually has a policy of trying to clean that up, meaning they want less output so that there's not a race to the bottom in terms of pricing. Because unlike what we're dealing with in other parts of the world, a little bit of inflation, they're dealing with deflation, which is a problem. Excess supply.
Moving on, our next section, looking at domestic stocks. First chart we're going to look at is small caps, Russell 2000. And this is a 20-year chart, so this is a big look back period. But I think, is that your drawing or is that someone else's?
That's someone else's.
I was going to say your drawing skills are improving if it was you, so I appreciate you not taking credit for it.
No, what's the old adage? Like, nothing's new in the financial markets and all data is data. So if somebody makes a good chart better than we can make it on our own, we'll take it and give credit.
Amen.
But yeah, new all-time highs, small caps, as you can see here, went sideways for quite some time. And as we've discussed pretty extensively, if in fact this does hold, one could pretty clearly and accurately say that we are just now in a new bull market for smaller publicly traded companies at large.
Which would explain we've talked about the lack of breadth with few companies driving most of equities returns, not just in the S&P 500, but broad all cap. If there was a broadening in participation, small caps that from a chart standpoint could look like a beneficiary. Certainly that's not a recommendation, just an observation. Next chart looks at U.S. equity indexes, their price to earning valuations versus history. And as we know, from a historical standpoint, many asset classes are extended, but others are not.
Yeah, so tying this into the previous chart, if you look at the S&P 500 or the NASDAQ 100, your biggest of big companies, yeah, valuations are high, but one could say that valuations are high because those companies cannot be replaced, which means they're going to naturally carry a higher valuation. But what this chart really shows is if you look at equal weight S&P, you look at small caps, or you look at mid caps, not only are valuations not high, they are both absolutely and especially relatively cheap to the mega cap. So we think that this chart is just a fundamental reinforcement for what was the price graphic shown previously.
Yeah, I mean, if if things don't fall apart, then money's going to chase something in equities, and we've talked about this before that $1 billion in Nvidia is a lot, or in mega cap tech is a lot different than $1 billion in mid caps.
Yeah.
That carries a lot more bang per dollar, if you will, investment, because they're just not quite as large. Next chart looks at the energy sector. As we've talked about, smallest part of the S&P 500 subsection of sectors, and it's been a laggard for some time.
Been a laggard, but interestingly, it's really kind of been moving sideways to with slightly upward bias since roughly 2022, right? So to the theme of kind of everything is starting to more participate to the upside, it looks like energy could be staged to make a move. Now, this is not to say that this should be an overweighted sector. Again, that's something of a different conversation. But what this is saying is that when the smallest and laggard sector is also starting to break out higher, this is just another piece of price evidence that the bull market could be broadening.
Next chart looks at financials, specifically the big mega banks relative to the smaller ones. And the megas have outperformed tremendously. And the question is there a potential for a catch up here?
Yeah, and looking back at what was the chart of the Russell 2000 small caps, obviously your smaller financials are going to carry a good size weight there, and these are not companies that have the type of earnings growth or margins or network effect by any stretch that
or breadth of cash flow, right?
Right.
Like the megas have the trading revenue, the investment banking revenue,
Exactly.
etc.
So we're not by any means saying that there's like a secular tailwind to this area of the market, but what we are saying is this is a laggard for some time and for good reason that could also be starting to catch up.
Yeah, the reason was commercial real estate. Smaller financial institutions, smaller banks hold a higher proportionate level of commercial real estate holdings and higher interest rates. So again, that's been the story the last several years on why maybe they've not kept pace with their big brethren. But yeah, the chart looks interesting. Which this is chart overload, so we're gonna talk about interesting charts and Justin's charitable endeavors.
Which I know you were surprised.
Yeah, it was impressive. Moving on, non-U.S. Equities. First one just looks at South Korea, which we've talked about here and there, but it's been a trailblazer this year on the international front.
Yeah, it's been a monster, and hindsight's 2020. But looking back, it was basically an AI play, but it was an AI more of a fundamental traditional play. And that if you look at the companies in South Korea, they're much more focused on the semiconductor memory market, which is, typically has more of a traditional business cycle to it than, say, the NVIDIA chips that are much more kind of cutting edge, tip of the spear. So as the AI trade broadened out this past year, South Korea was the beneficiary.
They had a presidential election that was pro-business, pro-markets.
Good point, yeah.
That was a catalyst as well.
Yeah.
Next chart looks at China as a percentage of the All Country World Index. And this one actually surprised me. I mean, I knew it was much less than the U.S., but that's pretty substantial.
It is much less, and it does stand out considering that it's the number 2 economy. But one thing to kind of asterisk about this chart is this does not include the Chinese companies that are primarily listed in the U.S., right? So when you consider that, it wouldn't be that big of a difference, but it would be bigger than what it's showing right there. This is mainland.
That's all on how you present the data.
This is mainland listed Chinese stocks, which, one of the big themes, if you look at any sort of stock markets outside of the U.S., generally speaking, your biggest and best companies that are going to attract the most investment, they will look to either do their primary liquidity listing or their one and only listing. They'll look to do it in the U.S. and, for good reason.
Access to more
capital, access to lower funding rates, and in the case of closely held companies, the ability for the founders to borrow more cheaply against their stock holdings.
Minor detail. Moving on, Brazil, another country that we reference often And this again surprised me. The number of data centers in Latin America. Brazil is leading the charge by a long shot. I would have thought it'd be Mexico, to be honest, because of the close ties with the
Well,
U.S.
it all comes down to energy, right? So Brazil
Yep.
is actually one of those countries that has such a diverse energy mix, whether it be hydroelectric, ethanol, plenty of gasoline, nuclear, et cetera, that you could put a tremendous amount of data centers there and it not be a constraint in terms of energy or the grid like it would be in a lot of other countries. So the most recent announcement that this graphic was taken from the article is TikTok. So ByteDance is actually looking to put their main core western part of the world data center there.
Interesting. And it makes sense. Access to cheap energy. Last chart in international is India's trade with Russia has substantially jumped over the last 3 years, which many countries have went in the opposite direction over the last 3 years. So this is why this stood out to us.
Yeah, and we sort of put this in there as, there's been so much in terms of the current U.S. administration sort of power playing, or one could say even bullying different countries to kind of do what they want economically. The two countries that have not only completely opposed that, but just went ahead and done the opposite if they wanted to, have been Brazil and then in this case India, where they're big enough to where they can pursue their economic interests regardless of pressure by Washington.
Moving on to interest rates. First chart looks at U.S. debt, U.S. Treasury debt outstanding, and it crossed 30 trillion.
Big number.
It's been going up. I mean, like anyone watching this right now, government debt's been climbing since you've been breathing, and probably before everyone that's watching this grandfather was alive, but it crossed a big number, 30 trillion.
What's interesting about this chart, you kind of have to squint and look at it closely, is even though the trend is obviously higher over time, you'll see two instances on this chart in which the slope upward increased notably, post-global financial crisis and post-COVID, right? Which those were both two instances in which the government said, hey, we're going to issue a lot more debt. And, at the time, the fear was the bond market was going to implode. And yeah, we've had some higher interest rates, and you could say there have been some changes. But generally speaking, just because there's been more supply, it hasn't outpaced demand, at least at this point.
Which nice lead in to the next chart, looks at the 10-year yield. Part of what Justin just said, there being more debt, meaning will it require investors, will they demand a higher interest rate for holding that? Looking at a micro time frame this year, that hasn't been the case.
Yeah, and this chart basically shows, going back to the whole Liberation Day period, and at that particular time, the narrative was in the bond market that because of trade dynamics shifting and because of the fact there is so much more U.S. debt outstanding, that there wasn't going to be enough demand and that rates were going to go higher. But despite that, what we've seen is as the Fed has cut rates with a bit of a lag, it's brought down 10-year yields seen in this chart also. So, we'll see where that goes going forward. I think if I'm not mistaken, Ryan, last week or 2 weeks ago, we had a chart showing the correlation breakdown between stocks and bonds. So that is one piece of evidence that would suggest things have changed a bit in the Treasury world. But in terms of rates moving lower across the rate cut cycle, that seems to be intact.
Well, and regulation can change it, as we mentioned on one of our videos talking about the 50-year mortgage. At its surface level, as consumers, you're like, well, if you can't afford a house on a 30-year, don't get a 50-year. But how does it change things? That would open the demand for 10-year longer U.S. Treasuries to major financial institutions, so it could drive
that's a great point. Like
interest rates down, right? Like we forget about those second and third deviations.
Exactly right. If there's a 50-year mortgage, then a bank can charge some percentage for that 50-year mortgage, and then they can just hold a 10 or even maybe a 30-year Treasury against that at less, and you just extend demand from banks across duration. So that's a good point.
Next chart, talking about the Fed, looks at disagreements on where to take the Interest rates next, and what is the neutral rate? That's kind of been President Trump's argument to Powell on lowering interest rates is that the neutral rate is lower than where the Fed's holding them. And anyways, the disagreements are showing.
Yeah, and if you look at this, you can basically see that those disagreements have gone up a lot since the move higher in interest rates of 2022, right? So as soon as inflation became higher and stickier than what the prior 10, 15, 20 years had, allowed for, then naturally there's more uncertainty amongst policymakers in terms of what you could do with that. And more recently, it seems that they've just decided to cut them anyway.
Yeah, cut them anyways, which they got some good news on the delayed, I guess, core inflation data that came out this week that I mean, it's a little stale, a few months old, but it was lower than anticipated.
When in doubt, cut them
And
anyway.
also, yeah, cut them when in doubt, cut them anyway. And well, they're saying the labor market's weakening, which again, the unemployment rate has come up. But I also, remind myself that none of the policymakers on the Fed board right now were policymakers the last time we had inflation where it is. So they're just studying it like we are. They never actually affected policy or decisions at that time. But
Well, and
anyways,
just to add to that,
moving
just
on.
real briefly, I think this might be important, and this is something that we talk about a lot internally. Is for many years it was sort of monetary policy that was driving the ship, but now you're seeing much more of what they call fiscal dominance, meaning that markets and the economy are much more focused on is the government putting money into the economy, and that's actually perhaps more important than what the cost of capital is.
Last section, commodities. This ties in with our chart on the energy sector. Is the International Energy Agency? They expect even bigger oil surplus next year.
So what's interesting about this is the fact that oil has come down quite a bit in price. I know we show that chart pretty frequently on here, but basically with the expectation of lots of oversupply into what was this year and then even more so next year, it'll be very interesting to see that if that's already reflected in the oil price, which then would just mean that the market might shift to what is a pickup in global demand, a pickup in the consumer. And then again, we're not calling for, north of $100 oil sustainably by any stretch because it is getting phased out by other types of energy and there is plenty of supply ready to come on, in various jurisdictions, but it is a tradable asset and, it might be the bear case for oil over the next 2 or 3 years might be close to priced in on the downside, I think is what we're coming to that thought.
Yeah, and as we've talked about, the consumer data, survey data, I mean, it's in the basement. It has been in the basement, to Justin's point. Any uptick, if it's already reflected in the price of oil, then there could be a sizable reaction in the opposite direction. Next chart looks at, again, I wish I could say, Justin, you drew this chart on silver, and I would call this a round trip from 2010 to 2025.
Yeah, it's interesting in that, if you went back and for those that remember, there was a huge speculative bull market in silver in, 2010, 2011. It was after the global financial crisis. And it was basically when, the narrative at the time was central banks were cutting rates too low and the deficit, Treasury supply was exploding. And back to that other chart, we've seen that it's only continued since then. But silver basically kind of did nothing and corrected for a number of years and is now breaking out to new all-time highs. The difference is now is that the narrative is more nuanced. It is the fact that government deficit, et cetera, but also the fact that there's an industrial use to it. At least that's the narrative. So it's probably just a speculative trade, but nonetheless, I mean, when you see a market go years without making new all-time highs and then make new all-time highs, you have to assume that the path of least resistance is higher.
Correct. Horizontal lines.
Horizontal line.
You didn't mention a
Well, I
horizontal
was going to
line,
let
and
you
you
do
had the
that. That's
opportunity. Yeah. It's good. Next chart looks at gold relative to copper. This is again a long-term chart, 25 years, and they followed very similar patterns until of late.
Yeah, and this is something that we've mentioned and we've been saying, at least from our asset allocation investment standpoint, copper has looked to be a superior risk reward for many reasons up until recently. And I guess recently it started to reflect that with the price having moved quite a bit higher. But unlike gold and unlike silver, where a lot of it is just kind of speculative demand, obviously copper, relatively speaking, has real economy use. And I think it was in the last chart overload, we put copper and iron ore, basically showing that, of the early to mid 2000s when iron ore was sort of like the barometer of economic activity, it's now copper because what was cities being built before is now data centers, ultimately.
And especially a lot of them in Brazil, apparently. Last chart looks at crypto. Bitcoin has fallen off quite a bit. We've talked about the correlation between the NASDAQ and crypto, that it's kind of fallen apart here recently, with crypto falling, going down. They're calling it the crypto winter or something, but the NASDAQ not necessarily falling near as much. But this looks specifically at some other altcoins that specifically President Trump and his family are involved in.
Yeah, so this shows Bitcoin, which has been down 20+% from the recent highs pretty quickly, but compared to some of these more so-called altcoins which are listed here, they've been down a lot more than that. And to your comment on, there is sometimes a correlation between, say, Bitcoin and the Nasdaq. If one were to have to pick which one is more likely to trade strong based on fundamentals, you would pick the Nasdaq, right? Because you don't put, even if it's Bitcoin, you don't put money in these crypto coins with the expectation of earnings growth and share buybacks, et cetera. You put money in those areas thinking that people are going to come in after you and put more money, right?
Greater fool theory.
Yeah.
Right?
Which
don't be the greatest fool is the guy that's holding it last.
Which is interesting. The greater fool theory kind of makes it sound like you're being pejorative and calling someone a fool, but which I guess you kind of are. But ultimately, what it means is like there's two ways to make money in markets. You make money because you think people are going to buy it after you, or you make money because you think there is a fundamental or structural reason that
demand is going to increase. People don't know about this product or service.
Right. Or you could just even say that as inflation goes up, that means pricing power goes up, and stocks that sell things at a fixed cost, even in highly competitive markets, assuming there's inflation, they should at least go up by the amount of inflation every single year, which goes to the
none of that.
Yeah.
The bulk of our conversation, none of that exists for any of this
Zero.
stuff.
Yeah.
Zero.
Yeah.
So, yeah. Anyways, but that's been this chart overload. We know there's a lot of places you can spend time listening to people talk about markets. We appreciate you spending this time with us. If you want to contact us, reach out to us at info@sollinda.com, info@solinda.com. We'll be back in a couple weeks to talk about our latest our latest thoughts on various charts. Get all your Christmas shopping done, especially for your spouse. But anyways, we appreciate it. See you next time.